People need an income that's guaranteed to them.
If you lose money to taxes, you're never getting that money back.
You need to get serious about adding some lower risk.
Greed. I don't like greed.
The thing to be afraid of, honestly, is the thing that we're not thinking of, the black swan event.
There's a tsunami coming. Bye.
Welcome to Retirement Coffee Talk with Charisse Rivers.
Just coffee talk.
There's a lot of noise, a lot of chatter. Who do you listen to? Who do you not listen to? You have to stay focused.
A fun and informative look at the issues of wealth, retirement, and protecting your life savings.
These advisors out there that were trained to sell, and have all these fees. They don't want to talk about this product, so they make less money.
And now, Retirement Coffee Talk with Charisse Rivers.
Hello again, and welcome to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth online. As always, it's zinniawealth.com. That's ZINNIA wealth.com. And if it's time to talk about your retirement, that is why we're here, to introduce you to Charisse. Maybe you don't have that person that you're talking to yet. Maybe you are asking your friends, well, who did you use? And how can I get in touch with them? Well, this is a show where we show you what's going on out there, how Charisse is helping people navigate through it. And if you would like to give us a call, it's 833-368-3680 for a no-cost, no-obligation look at your retirement. Just sit down and say, here are my questions. I'm wondering about this. Did I get this handled? Is my advisor doing the right thing? And then maybe sometimes you find out that they're not, that there's more to do. That's why we have this show. Charisse, how are you doing today?
I'm doing pretty good.
Pretty good. What happened?
I have a bum ankle.
Uh-oh. From?
No. Pickleball. So the kids and
I,
yes, we decided to say, let's get committed to pickleball.
Uh-huh.
And we did our first lesson, and Ella is naturally just really great at everything she does. And she's played it a couple times with her friends. So she was good. She's trying to school me the whole time. Mm-hmm. And Eli, it was really one of his first times playing. So, it took him a day to get that figured out. By day 3, they were both just hitting it really hard, consistently. Even my son, I was so surprised. I was like, wow, he's really picked this up quickly. Mm-hmm. And they decided on day 3 that both of them want to play against me. Mm-hmm. So I knew I'd be running all across the court. So I won. I just want you all to know I won. And I twisted my ankle winning.
Okay. It's so shocking to me that your children are competitive. I where did this come from? I don't know.
Can I tell you, if you were at the court, we were so loud and we all got so competitive. I'm going to tell you, this is the second time I've seen my children like crazy competitive besides Monopoly a month ago or so. And it was so much fun because I just love seeing them want to beat their mom and just really get good. And it was just so fun. It reminds me of a conversation that I have with Tim Tebow, and he says, oh yeah, my mom, my dad, my sister, we were out there playing volleyball and we were smashing this other family. We had to win. And like, that was that's how they did their thing when they'd go on trips together. I'm like, oh, it sounds like my kids now that they're older. So it was a lot of fun, but I have a hurt ankle, so I'm taking a week off.
All right, good. We're chaining you to the desk. There will be no mountain climbing this week, okay?
None.
All right.
No, but it was fun.
Well, speaking of climbing mountains, some people look at retirement that way, and it is kind of a big mountain because, there's a lot to know out there and there's a lot to be concerned about. And people are looking at the market right now, Charisse, and they're wondering, is this real? Because I mean, you see Intel and they're up like 200%. And I found another one, Micron. It took them 37 years to get a market value of $100 billion. It took them 3 days to get to $200 billion. Come on, man. I mean, that just can't be real. I mean, I am a little worried about all of this, that the shoe is going to drop, something's going to happen, and down she goes. But anyway, I'm reading an article about all this, and it said that you should approach this market with 1 foot on the gas and 1 foot on the brake. Yeah, I get how. How do you do that? So that's got to be one of your big challenges, is finding that balance in a market like this. How do you do it?
So it kind of reminds us of the 2000 to 2002 tech crash, right? Just we are all tech heavy. It just plummeted, and this could be the artificial intelligence crash, right? And we don't know, but where's all the value and real return in it all, which we're not seeing. So the math doesn't make sense. And I always say, past performance is not indicative of future results. So times could be changing, but the growth has been fantastic. I was just doing a review with a client and they've been with me for 10 years. I remember the first 5 years, it was kind of, we're trying to see where's our growth? And because it was up, down, up, down. And the last 5 years been nothing but skyrocketed up. They were like, Charisse, our returns are just off the charts with you for the last 5 years. And how long can this last? I'm like, you know what? We're going to keep going while we can. But that's why we have the safe money strategies built in. And they always know what their safe money strategies are because there's quite a few of them built in. And then they also have this other bucket, which is this growth. So we want to take advantage and put the metal to the pedal when markets are good. But we also want to make sure as you're prepping for retirement and or in retirement, that there is a game plan for what if we have a tech bubble crash like we did for 33 months as the stock market's going down in 2000 all the way to 2002. And not all of our money has to make 15 to 25%. Some of our money can make 4 and 5 and 6 and 7 and 8, right? That's your safe money strategies. If we're averaging, 4 to 6% in a retiree's portfolio over the next 10 years, that's what we should be looking for. But the averages have been so much higher that times are changing a little bit, right? And people are taking more risk, Randy. When people come in and we do a portfolio x-ray and a second opinion review, I am seeing an absolute highest level of risk than I've ever seen in time. And I've seen a lot of these stock docs out there that people are working with and advisors that they're putting them in more tech heavy, right? Because tech heavy is hey, that's what's working right now. But there's no plan for the income if the stock market were to go down. And one of my reviews that recently came in said, okay, Charisse, I have $3 million with you and 1 million is totally safe. We've averaged about 6% in it. And the other one is a moderate portfolio and the other one's a super risky portfolio. Okay. He's like, I want to make sure we're in line with my income needs because they need a very high number when it comes to income to cover the gap that Social Security doesn't cover because they love traveling and they're still super young. And I said, well, that's part of our conversation today. So what we're doing is we're implementing a second version of phase 2 of the retirement plan, which we do when the timing just makes sense. And it depends how long you've been with us and how much growth we've had, where now we're going to take some dollars and really just put it in the other piece of the Zinnia puzzle, right? So we have something called the Zinnia 5. And we don't ever talk about it on radio. It's kind of our thing when you come in. But it's part of building your retirement by design. That's the basic strategy. And building a retirement plan by design does not mean your portfolio will stay the same. Our clients' portfolios change on an average of every 5 years. Somebody who's been with me 20 years, they will tell you that to be a true statement. And we want to adapt to the changes. We want to sprinkle in other growth strategies and other safe strategies. A safe strategy is not a CD. Right? It's not a money market. It's not all your money in annuities, right? It's not all your money in bonds. You have to have a mixed strategy. And as things are coming, you have to have an advisor that's not afraid to use other investments to help your portfolio average out a higher average. Because if you have a 60-40 portfolio right now, it's doing all right. I'm going to tell you, it's probably doing great right now. But it wasn't doing great 2 years ago, and it wasn't doing great a year ago. And when interest rates shift gears, it's going to go back to not doing great again because interest rates change how you make money in your bonds. And the advisors are not changing your strategy. They're just set it and forget it. And you think they're managing your money and they're making all these trades. You're like, Charisse, I see it rebalance. I'm like, yeah, by law, we have to rebalance. It's an auto button. Nobody touches it. It just happens automatically. So people think that's active trading, yet when the interest rates go up and their bond values go down, then they're asking, well, why did I not make as much money? Right. And that is the reason. It's an autopilot game. And we don't do autopilot here. And we're always shifting gears as gears are being shifted because I don't want to be going backwards all the time. And so we got to be able to shift between all the gears when the timing is right.
Well, you think about it, if you were to look at the last 20 years, last 25, 26 years, and look at all the stuff that has happened in 25 years, a retirement is probably about 25, 30 years, right? So who's to say that from today, for the next 25 years, we're not going to see the same kind of stuff? Now, I don't know we're going to go through another 2008, but maybe there's something else out there. We've had plenty of things that are affecting the market. To have an advisor that is moving with all of that and changing strategies as interest rates change, as the economy changes. I mean, look at what AI has just kind of come up and just taken over. We didn't know that 5 years ago. Well, we don't know what's going to happen 5 years from now. Let's have a plan for it, and an adjustable plan for it at that. Here's the number to sit down with Charisse and get a no-cost, no-obligation look at where you are right now. If you have an advisor right now, that's okay. Come on, bring it in, and she'll give you an evaluation of it. If you don't have an advisor right now and you're just getting going on retirement planning, let's start from scratch. It's no cost, no obligation to get going. 833-368-3680, 833-368-3680, or online, zinniawealth.com, ZINNIA wealth.com. There's a gold box there. It says complimentary retirement consultation. Click on that and you'll be on your way. All right. So if you look at how retirement has changed over the last couple of years, there's been a significant change. We've all talked about the age of the pension and how that's kind of gone away. Well, when pensions were king, people retired at about 62. They got their Social Security. They triggered their pension. They had their savings. Bing, bing, bing. Three-legged stool. We're on our way. Easy, simple. Well, the pensions went away. That knocked out that part of the stool. Social Security says that they're going to cut back that part, that cut another leg off the stool. This is not good. And what's happening right now is the retirement age has moved up to 65. We are having to plan and save another couple of years to make up for the fact that we don't have pensions anymore. Well, Charisse, I wanted to ask this. If somebody came in at 62 thinking that they're going to have to work to 65, are there times when you sit down and say, you know what? You've got the income. All we have to do is have some income planning here, and you can retire. You think you can't, but you can.
Pensions are certainly a dying breed. And in 1978, when they created that 401k, those pension managers did not, and these companies did not want the liability of making sure you got income in the future. So they created this beautiful 401k, and you saved and it worked. And a lot of people have a lot of money in those buckets, but now you are your own pension manager, and life after the 401k totally changes, and people spend less money and they retire later because they don't know what to do. They don't want to run out of money. They don't know how to take income checks, and they retire later than 62, Randy, is because they get Social Security at 62. They know if they wait to retire to 65, they're going to get more. But when you don't have a secondary paycheck coming in to cover maybe some of your fixed bills and some other things, it is an absolute psychological and emotional hesitation that people have. And what I have learned that most advisors are not coaching is that if you have a income plan, a well-written income plan, most people don't have income plans like we have here. People will retire at 62. They won't wait till 65 because they also wait till 65 for insurance. And we let them know, hey, you don't have to wait because you have enough money for insurance and it doesn't erode your long-term investment plan, right? And so until people come in, we can build a pension, right? You're going to get Social Security. If you want that pension and you said, hey, Charisse, I got $1 million and I do want a pension. I don't want all my money in a pension. Can you create that strategy for me? We can absolutely do that. I never recommend all your money into that bucket because you're going to want liquidity and you're going to want to make sure a legacy is growing and you want long-term care coverage in case you need it in the future. So we want to be very diversified in our choices. But I will tell you, when you have a pension income, it gives you the okay to spend more money because it's always going to show up and it's never, ever going to go away. So it makes people feel comfortable that they can just keep spending. And those people who do have those pension checks coupled with Social Security, they still pull money out of their lump sum, but they don't pull as much because they don't need as much. Therefore, they're still spending more money than the average person who comes in with just a Social Security check and a 401k until they sit with us and we build that out for them. So I tell people, don't be afraid to come in and see what that's about. Don't be afraid of the conversation. Don't keep waiting because you're buying income. When you purchase a pension plan with us, and it takes a little time to grow. It could take 2 years, it could take 3 years, it could take 5 years, but it's growing at a guaranteed rate on your pension income side, which is really valuable to you. If you wait and come in 5 years, and then we start it, then you probably have to wait a couple more years to take it. So we want you to take it when you want to take it so that you feel that comfort level of spending that money earlier than later. So that's why it's just really important to plan ahead before you retire, that 5-year mark before retirement. But if you are retired, you can still build that in. You just might want to hold off a little bit so it can grow, in my opinion.
Well, 401ks have been a great savings vehicle for us, but they don't do anything for you when it comes to income. When you get to retirement, your 401k doesn't automatically pay you like a pension. That is up to you. That is where Charisse comes in, said, you've done a great job saving. Look at this nest egg. Let's build income out of it. What does it give you as a paycheck? And then combine that with Social Security. That's what retirement planning is. Give Charisse a call. Let's go through that process. Maybe you are heavy 401k, which is great. But what does it do for you in retirement? Let's figure it out. 833-368-3680. Again, 833-368-3680. Or use the website, which is zinniawealth.com, ZINNIA wealth.com. Click on that gold box. Well, Charisse went down to Mar-a-Lago not that long ago to hear Donald Trump Jr. speak. We were able to fire a few questions at Donald Jr., and this was kind of interesting. He talked about building. Obviously, his family is big into building, and I think that we can probably take some tips from Donald Trump Jr. when it comes to building a building to building a retirement plan.
Hey, if one day you're going to go build a building, you better know how to dig the foundation. You better know what it costs to actually do these things. You better know how much time it takes, because otherwise someone's just going to screw you blind if they just think, you're just the guy in the gilded office with no understanding of what's going on. You're going to get taken advantage of. And so I learned so much more, and we really were, raised by like construction workers far more than the executives. He said, there'll be plenty of time for the executive stuff once you get out of college, but when you're young and you get those formative years, you're going to live with those tough guys that'll actually make you tough.
So before we get into it here, Charisse, I don't hear him speak that much. It's his dad is always on. And what kind of a guy? I mean, he seems like he was pretty approachable. What was your impression there?
I was absolutely surprised. He really right away put his guard down, was very comfortable, had jokes. He was telling a story about his dad having these parties when he was 7 years old, and he's throwing raisins down from his room. It was so fun just to learn this inside stuff. But what brought that conversation up was interesting. He said that his dad every summer made his kids go do a job, a normal job. So they would go to a farm and learn how to farm and do tractors and drive tractors and forklifts. I was surprised. I mean, straight up, I went, so this rich family, the dad, President Donald Trump, made their children go do real work to learn what life was like and how stuff gets ran. I went,
that's interesting.
That's why he's the president. This is why he's a good business guy. And even though we don't like all the things that he says, but I was impressed with just the parent training that he put his kids through, which is why the kids are so probably well done. They do their jobs right. They're hard workers, and he did a great job speaking, and I was thoroughly impressed. And he was fun, and he had jokes. I was like, okay, this guy's funny.
Well, let's talk about what he said there, because he related to building a building and going about some task in your life. And what he was basically saying there is you need to talk to the people who have boots on the ground. You need to talk to the people who are actually doing the work, not necessarily the foreman who's up there or the guy who owns the place who's in the gilded building, as he said. Right. So I look at that and I say, that's you, Charisse. You are that person with the boots on the ground. You are the person who has to do the X's and the O's of retirement planning. And sometimes if people go out there, there are folks that may not have the same skill set you do. There's a lot of people out there that say that they're in the retirement planning business, but there's a lot of different kind of requirements and different initials in back of their name. There's a lot for people to weigh through, isn't there?
Yeah, there really are. There are different types of advisors out there. People would think an advisor is an advisor is an advisor, and that is not the case. You got your insurance agent, you got your CFA, you have your CFP, you have your investment advisor, you have your fiduciary, you have your stock job, right?
It's just a lot.
And not all advisors do the same thing. So when I got into this business 20 years ago, I got in 2007 when the market was crashing. Wow, that was really smart of me. But I learned a lot during that time about people's emotions, what was happening, how important it was to have income because people had to stop living on income so they didn't run out of money. But what happened is most people did not. So early on in my career, it was kind of like what he did when he was a kid. He was on the farm, learning how to drive tractors. Early in my career, I was learning the basics, how to coach up Medicare, long-term care, how to talk about investments and financial planning. And from there, I just grew and I learned. And every 5 years in this business, something new came to me, a new idea based on problems clients had in the past, based on things I saw coming our way. So being able to think through that and actually tackle the problems as they come and grow from it and build from there is what he's talking about. And unfortunately, in the financial services world, people aren't thinking like Donald Trump Jr. They're just set it, forget it. This is what I know. I'm not going to go any further on it. I'm not getting educated. We're just going to buy these stocks. We're just going to buy these mutual funds. And we're not going to build an income plan. Just let me know when you're ready to take income. I know you all are listening right now. You heard that 1,000 times. Just let me know when you want to take income. But yet they won't show you an income plan because they don't even get it themselves. This is why I help retire finance professors. This is why I help retire financial planners because we know how to do it, this phase of life. So the advisor does matter in your world and the investments the advisor has. So I'm a fiduciary. I'm an investment advisor. I mean, I do everything, right? Think about Fisher Investments. They're a fiduciary. They do nothing. They do one thing. I mean, think about it. The Zinnia 5, it starts with your investment plan. Fisher Investments doesn't have a Zinnia 5. They don't have a Fisher 5. They stick to the one thing. They stick to the investment plan. And they charge, 1.25%? So you're being charged 1.25% for the one piece that we offer 5 of, right? And the second most critical foundation for the rest of the 30 years you're going to live in retirement is number 2 of the Zinnia 5, and that is the income plan. But Fisher won't do the income plan. Most people won't do the income plan. They don't even know how to do the income plan. They don't want to do the income plan because you know what? It's just easy to sell you a 60-40 portfolio full of stocks and mutual funds. That's the easy way out. And and you're going to go there and you're going to fall short because he sounds good. He looks good. He's got all these commercials. He must be good. Yet your advisor you're sitting with lives in Tampa, right? They're not even local. It's insanity to me. And when you get sick and tired of being sick and tired, people come to Zinnia. They're like, teach me about how you're different. And every time we sit with a Fisher client, they're like, this is different.
Why don't you give Charisse a call and have her take a second set of eyes on what you got going on right now? Maybe you're starting from scratch. Okay, we talk about that all the time, but maybe you have some kind of a plan that you put together or somebody else put together, and you want to get an evaluation of that. Is it going to work? Are there any holes here? When you want to know that, you don't want to be 72 years old or 75 years old and go, wow, didn't see that coming. That's not what you want in retirement. Give Charisse a call, 833-368-3680, 833-368-3680, or online, zinniawealth.com. Click the gold box, and you'll be on your way. All right, we're going to dive in just a little bit here on how Charisse puts together portfolios. And, you walk in and say, okay, Charisse, how would you invest this money? I found an article in Investopedia, and it talked to a financial advisor, and they said what you should do with this is start with the job, not with the product. In other words, asking you, what do we need? Do we need income? Do we need long-term growth? Do we need short-term growth? Do we need tax-favored savings? All these different things. You hear people say, look at the end and work backwards. Is that something that you do? Is that a philosophy that you kind of follow, something that you put in there?
Well, if you're 200 pounds and you want to get to 160, there's a mixed bag of strategy there. Right?
Okay, well, yeah, but you have the end in mind. I want 160. Yes. Okay, so now we know what the end of the journey is. How do we get there? Okay, I got it.
Right. And the problem is most people, you walk into them. Let's say you walk into a big bank or brokerage firm. You bring your statements. You're looking for a second opinion. You just left your 401k. You retired. You walk into this big bank or brokerage firm because they're big and they're probably a good company, right? And you walk out with a portfolio that's full of stocks and bonds, maybe a CD, and that's it. They're selling you a product. They're selling you some mutual funds. And so instead of that strategy, I call that the old school strategy. That is your grandpa's strategy. Listen, we don't do that here. What we do is we build out that you want to be 160 pounds in 10 years and you're 200 pounds now. We're going to build out a strategy. And the only person who could screw it up is you, right? Or the person who's actually managing your strategy, if they're a bad personal trainer,
right,
or they're just not doing their job, right? Most personal trainers are always doing their job. But the same thing with the advisor. So if you say, hey, I have $1 million here, Charisse, and I'm getting $50,000 in Social Security, but I need another $50,000 to spend for the next 10 years, I still want my $1 million to grow while I'm taking $50,000 out. Well, I have a big job because if you have $1 million and you're taking $50,000 out, that's 5%. And you're supposed to follow the 4% rule, not take more than 4% so you don't run out of money. But you're lucky you sit with me and not a typical stock jock, because we will implement the plan. We will get you that $50,000. Your portfolios will grow because we're not just doing a 60-40 mutual fund portfolio or a 60-40 just stock portfolio. We are building things that create an inflation adjustable income. So you're going to get more money every year if you need it, but it's built into the plan. And then we're going to have probably 6 to 7 different buckets doing different things. And one of those buckets is a 60-40 portfolio. So yes, you're still going to get that 60 portfolio the stock jock's going to get you. But we're also going to build in other things that we know that you're going to need as we're helping you build your retirement by design. It has to be designed. It is not cookie cutter. I am so tired of the cookie cutter world, Randy, because we work so hard here to design your portfolio, and 3 people can come in one day and all 3 people have a totally different plan on when we turn it on and if we need to build income or if we need more growth or more of a tax strategy, a dividend strategy, right? So it's important to us that when you are retiring, you're retiring by design, not by hope, not by just a basic strategy, because it doesn't work as well. And I can show that to you.
Well, one of the things about retirement planning, I got to believe, is people come in, as you say, and they all have different needs and they all have a different idea of what they need from someone like Charisse. Somebody might walk in, you might walk in and say, all I need is my money to move forward. I need growth. And it's all about investments. But somebody else might come in and say, you know, Charisse, I'm worried about long-term care. I'm worried about health care. I'm worried about taxes in retirement. I'm worried about legacy. I don't have that part nailed down. That's looking at the end in mind, going way down there and saying, okay, let's solve those problems as well, and then get that investment plan for you as well so you have the income that you need. You're going to go about it differently than anybody else. When she says no cookie cutter, that's what it means. That means your plan is going to be different from anybody else's. Let's sit down and build your plan. Do your retirement math. Here's the number, 833-368-3680, 833-368-3680, or online, ZinniaWealth.com, ZINNIA Wealth.com. What does that do? Let's get a date on a calendar and start the conversation. Talk about your concerns and what you want from your retirement plan, what you need, what you're thinking about. What you've done, what do you want to do? Let's put it all together. 833-368-3680. Well, I looked at this headline, Charisse. It says millions of Americans spend decades saving for a retirement only to trip over tax bills at the finish line. So it talked about the 3 different kinds of money that we bring into retirement. There's the pre-taxed stuff. That's your 401ks and your IRAs. You've never paid taxes on that money. Then there's the after-tax or tax-free money. If you have a Roth, you've already paid taxes on that. That's tax-free in retirement. And then the taxable accounts. So pre-taxed, after-taxed, and taxable. We got all that going on at the same time.
Yes.
So I'm thinking like a pie here, Charisse. Should my pie be 1/3, 1/3, 1/3, or how do we mix this up? Does there come to a point when I've been plowing money into a 401k and you look at me and you say, no more? We got to have a different kind of money. How do you deal with this?
So we teach this in our workshops. It's a very heavy tax conversation. And there's 3 buckets. Think of it as the pink bucket. That pink bucket is your 401k, your IRA, all the tax deferred dollars you never paid taxes on that you saved with the employer, right? So that's the pink bucket. And then we have a yellow bucket. That's your brokerage account bucket. That is, let's say you buy some stocks because you just sold a house. You're like, Charisse, I have $100,000 and I want to buy some stuff. So you put it in this yellow bucket, the brokerage account bucket. That's the taxable bucket. So that's different than the pink bucket, which is the tax deferred because that was your 401k and IRA. The yellow bucket is your brokerage account bucket. And we have to be careful what we buy in there, right? Because there could be dividend stocks and you have to pay taxes on it every year, and or you can just do growth stocks where you don't pay taxes till you sell. So the question is, should we have more in the pink bucket or the yellow bucket? And then there's the third bucket you're talking about. That's the tax-free bucket. I call that my black bucket. It is my favorite bucket. And by the way, my favorite color is black, but I wear lots of bright colors these days. So remember that. Favorite colors are black, and the black bucket's my favorite because those are tax-free dollars. My goal is to move you from the pink bucket, that tax-deferred 401k IRA, over to the black bucket, my favorite bucket, because all those dollars, as long as you've had it for 5 years and you're 59 and a half and older, it's all tax free. And so why is that so important? Because over time, over the next 30 years in retirement, you are forced by law to pull a higher percentage out of those IRAs every year, that pink bucket, which is going to cost you a whole lot more in taxes over 30 years in retirement. What if you were to roll that pink bucket money over to the black bucket money over the next 10 years and you only pay taxes for 10 years and you live 30 years? And then later on, taxes go up. You're like, wow, that was the best strategy in the whole world, right? But to move money from the pink bucket to that black bucket, so that tax deferred bucket to the tax free bucket, you got to pay taxes that year. And I'm going to show you how to do that. But let me go back to my yellow bucket. That's the in-between bucket. Because your question, Randy, was how much should you have in each bucket? Well, when most people retire, if you have $1 million, you have approximately $800,000 in the pink bucket. And you have approximately, I would say, an average of $100,000 in the yellow bucket, the brokerage account bucket. And then you typically have, maybe if you're lucky, $100,000 in the black bucket, the Roth bucket. Because the 401k is where you shoved all your money your entire life. So what we want to do is, if I had a choice, I would move 100% from your pink bucket to your black bucket, and we'd have no more pink bucket.
Gotcha.
That's your tax deferred 401ks, and move it to the Roth IRA. But a lot of times, some people just there's other things they need. So once in a while, we'll move it from the pink bucket to the yellow bucket, right? That's the taxable bucket. It depends on quite a few things. So we always want to have a little bit of that yellow bucket because we can do tax loss harvesting on that bucket to give you income in the short run, as long as the timing works out without having to pay taxes. So tax loss harvesting, most advisors don't do it. Your CPAs will charge you a fee to do it and we'll do it for free. So again, it's a little confusing, but just remember, pink bucket, yellow bucket, black bucket. Charisse wants your money in the black bucket. And not everybody should do that, by the way, because when we do the math, sometimes the math says otherwise. So let us do the math. And at least moving forward. And you can move money from that pink bucket to the black bucket anytime you want, by the way.
Yeah, we've said this a couple of times today, that your retirement plan will be different than anybody else. If someone comes in and they've got a nice pension and Social Security, their income needs might not be that much. but their tax needs might be something big. And then you might be completely the opposite. You've got all sorts of 401k money, but no pension and Social Security. Now you have an income problem, and we have to move things over to that black bucket that Charisse is talking about. Everybody's going to be different. Let's figure out what you need in retirement. Is it income? Is it tax planning? Is it all of the above and all the different things that we talk about here on the show? Give Charisse a call. Let's figure out what the needs are, and let's start moving the plan forward. Start doing the math on your retirement. 833-368-3680, 833-368-3680, or use the website, pretty easy, zinniawealth.com, ZINNIA wealth.com, and hit the gold box. You'll be on your way. All right, big question. How much do I need every month in retirement? Well, we're going to tell you. The new numbers are out. This is from the Bureau of Labor Statistics. Last year, the average retiree spent $5,000 a month, $60,000 a year. That doesn't seem like a big, heavy lift. You put your Social Security in there, and that seems like it can be done. Now, where did they spend their money? This is interesting to me. 36% on housing, 15% on transportation, keeping the cars going, 13% on healthcare. Still no fun here. 13% on food, 7% on utilities, 3% on clothes. Still no fun here. And then 3% on household operations. Oh, here it is. 5% on entertainment. That's $3,000 a year. That's ridiculous. Come on, people. All right. So that's got to be something. People come in. Do they know how much they spend per month on stuff to keep the house going? And do they know what that number will be in retirement? And do they think that the fund number is going to be a whole lot more than 5%, and then it gets to be a surprise or even a problem?
I will say 70% of the people who come in and see us, they know what they're spending on their bills, their insurance, if there's a mortgage, car payment, food, electric, cell phone. So they know that part. I think the part that is always hard to tether money and thoughts to is the miscellaneous bucket. And then that entertainment bucket, which is also the travel bucket. So $3,000 a year, when you said the average person is living on $5,000 a year in retirement.
A month.
I was like, that's not my typical client.
You think that's,
right? Our
that's
clients,
higher?
That's low. No, that's low.
Okay.
Our clients live on a much higher number. And that's because, I mean, a lot of them have their debts paid down. But the average monthly cost for their expenses could be between $3,000 to $4,000. So if it's $3,000, it's $36,000 a year. If it's $4,000, that's $48,000 a year. And then again, you need a $57,000 income to pay $4,000 in bills.
Right.
That's the gross amount, because you got to pay the taxes afterwards. So then if you want to sprinkle in entertainment and you want to sprinkle in travel, you need at least another $10,000 to $20,000 to $30,000. So we coach our clients like, hey, let's see if we can hit that extra $30,000 just for travel. And we'll build in miscellaneous bucket, birthday present, Christmas present. That's part of your fixed asset, right? So we try to coach people to do that. And then we create this other bucket for the entertainment bucket. Some people are like, Charisse, we're never going to travel. Our entertainment's movies, and we like to do stuff in the yard. Then your entertainment bucket will probably be $10,000 a year, maybe. We got some people's like, Charisse, I'm going to do one cruise and we're going to go, do one other trip. So you probably don't need more than $15,000. But then we convince people, by the way, we're really good at coaching people up to go to Europe and do the Alaska 2-week trip, go rent a house and the Keys for 2 weeks and have all the kids come down, helping them spend their money on them and memories, right? And so we like to buffer the first 10 years with an extra $30,000 just on entertainment if we can. But how in the world can we do that if we don't build out a design plan, not a cookie cutter plan to give you confidence and be okay doing it? And every year we tweak it and we make changes. Remember, we are retiring by design, not by accident, not by hope, not by just call me when you need your income. We want to design the next 10 years of your life when you're retiring. Or if you come to Zinnia, because some people have already retired, you get 10 years with us to overfund your retirement in case you didn't get to do it before. So we're going to show you, can you do it? How do we do it? This is how it's going to work. Then we create the next 10-year plan and then the next 10-year plan. So we have 30 years with us. I don't care how old you are. If you're coming in at 70, we're going to assume you're living to 100, right? Just what if you do? You don't know. We do want to look at health and, what's happened in the past, of course, but we want you to have a design. And we do that with our Zinnia 5 strategy. That's our framework. And the philosophy is just retire by design, because these people in this example are not retiring by design. They're retiring by default, and they don't even know what's going on because I can see the math and none of it makes sense. So come in and do the math, because if you do the math, you'll know for sure where you stand.
You're listening to Retirement Coffee Talk with Charisse Rivers at Zinnia Wealth. And in the words of Larry the Cable Guy, let's get her done. Come on in and let's do some math on your retirement. Give her a call, 833-368-3680. If you've been wondering about this, there's no reason to sit around and wonder. Let's get you some answers on what's going on. And if there's any gaps in your retirement plan, let's get them filled. Let's have an answer. As Charisse says, let's have a strategy for it. 833-368-3680. Well, Charisse, I know that there's a lot of people that love the stock market, but there's also a lot of people that hate the stock market. They don't like the risk that comes along with it. I love the fact that my money can go up, but boy, do I hate the fact that my money can go down. So there seems to be a nice little place in between for some people. The people at 24/7 Wall Street said, if you want to be in the market, but you hate the risk, but you want some growth, they suggest using a utility ETF. They say there's less volatility and pretty good returns. Have you found that?
That is, I'm calling BS.
Calling BS on this one. Okay.
BS on this one.
Okay.
And the reason why is I used to trade all of our accounts here at Zinnia. And I was really great at sector rotation. It was my favorite strategy. It's actually I love that strategy. And I've been taught, hey, the utility ETF, it is a safe way to go when markets are going down. Yet the utility ETF dropped 32% and stayed there for a year. It paid what, 3% dividend? Who cares? What is 3% to a 30% loss?
Yeah.
That's a Duke Electric. That's a Southern Company. Those are your electric companies. And yes, I know there's times to get into utilities and a time not to get into utilities. But if you have a Fisher investment, they're not getting you in and out of utilities. They're keeping you there. So when it takes a dump of 30, well, you're feeling the pain. That's not a safe money strategy. I had to learn that. Right. And I realized, okay, just because ChatGPT, which wasn't here back then when I was doing that, but if you look at it now, says it's a safe place to put your money. Yeah. Why don't you look at the charts? Look at Duke Electric, look at Southern Company, look at Next Era. They stayed in the dumps for years. And it's like, where's my growth? So listen, we want safety and we want to build it in. But that is the most cookie cutter design that you can get at a big bank and brokerage firm. I can promise you that we will not be employing here at Zinnia Wealth Management. But we do active management. And sometimes you'll see that utility ETF in our portfolio because the timing is right. And then we'll have to pull it out because the timing's not right. Or we'll have less of it because it's starting to get volatile. So that's active management. So that's different than the buy and hold. So again, build in safe money strategies, growth strategies. And it's not just that basic strategy that you are all used to.
But the main thing here, though, is, Charisse, there's different levels of risk in the stock market itself.
Yes.
I mean, it's not like as a retiree, you say, okay, I want to be in the stock market. And you look at them and say, okay, Bitcoin, hedge funds, and private equity. That's not necessarily what we're looking for here. That would be as you referred to, the jiggliest thing out there. We don't want that in retirement, right? We don't want the wobble back and forth and running back and forth in the wind like that.
It's the jiggle. It's the jiggle.
The jiggle effect. Yes, exactly.
Yeah.
So there are places, though, to go within the stock market that you can find that don't have the jiggle that we're talking about here that might be a little more appealing to a retiree.
Absolutely. And it might have jiggle just not as much jiggle.
I love the way you talk. It makes sense to me. All right.
Okay. Yeah.
Well, what we want to do is find for you the retirement plan that not only works for you, but is also comfortable for you. Because if you're on your cruise and you're worried about your investments whipping back and forth, what kind of retirement is that? Come on. Let's sit down and find that place that is comfortable for you. We've said it so many times today on the show. It's not cookie cutter. It's not going to be what your brother and sister did, what your mom and dad did, what your coworkers are doing. It's going to be what you are doing. And let's figure that out together. It's a no cost, no obligation meeting with Charisse. 833-368-3680. Give them a call and let's start the conversation. Just start talking through what your concerns are. 833-368-3680. Or if you prefer to use the website, it's real easy. ZinniaWealth.com, ZINNIA Wealth.com. And there's a gold box. And you'll see it. You just click on it. It says complimentary retirement consultation. It's a big word for let's have a meeting. No cost, no obligation. Let's just talk through your retirement. Again, ZinniaWealth.com. Charisse, that is all the time we have on this one. I'll give you the last word.
All right. Well, I hope you're enjoying the summer and putting a lot of SPF on because it's a hot one this year. And as you're putting on that SPF, tune into our podcast and hit the rewind button because there's always some good juicy stuff out there. And I promise you won't get sunburnt listening as long as you're under an umbrella. So as usual, go to, I would say, Spotify, iTunes, your Apple phones, podcasts, basically anywhere you can find us. Live by design and not by default. And we'll see you here next week.
This has been Retirement Coffee Talk. To find out more about how the strategies we've discussed on this program can build the retirement you've been wanting, call Zinnia Wealth at 352-368-3680 or visit us online at ZinniaWealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.